Hi, this is a very short video on the session 3, financial analysis, where we are covering all the things related to ratios. So there are a few questions that you might have. Why do we need to use ratios? Do we need them at all? Yes. The main thing is that we need ratios to make better sense of what is in our income statement and balance sheet. Ratios help us. They help us to understand what is the current situation. They give clues to the people in charge of financial management of the company, and overall, they help us to understand what are the things happening in the short term in the company and where they might be going in the near future. There are a couple of problems that we need to deal with, that we have limited insights, so a ratio is usually a number, and that also they are contingent. So what a ratio that might look good at some moment in time, maybe at another moment the situation has changed in the company or even in the country, and now that ratio is not that good anymore. This has happened, for example, in the last global financial crisis, where the debt levels at some point were tolerable, and then during the crisis were seen as highly risky. To be able to do good work with ratios and financial ratios, we need to have good accounting. If we don't have good accounting, the data that we are using doesn't provide us actually with valuable insights. We also need to know where to find this data. That's what you will be doing. And then once you find some of this data and you discuss some examples of potential sources you can use, we will be covering these questions. Those are just examples of questions that you can use. So what are the main 5 blocks of financial ratios? Profitability margin, return on investment, asset efficiency, financial leverage, and liquidity. Quickly looking at them, the first block is basically the one that deals with those elements that are built on the income statement from the top line revenues to the bottom line net income. In the second block, we are looking at the return on investment. So thinking about investment like the assets that the company has. Is the company being able to generate income with all those assets? Just now, for example, we can also go into more detail and think about not only all assets, but to actually, let's say, only those assets that are financed by the equity of the founders of the company or the stockholders. Let's look at that. So that's ROE, return on equity. Then we can move on and we can try to understand how the company is actually managing their assets. Are those assets helping the company to generate revenues? Let's look also at inventory, and we can even analyze the accounts receivable based on how much those are related or not to the credit that it gives to the consumers or customers. The block of financial leverage helps us to understand the way that the company is structuring their assets. How risky is the company? Are they getting a lot of external investors, in this case like debt holders, involved in the company instead of getting stockholders? So how does this affect the company? The last ratio that we have on the times interest earner ratio gives this information also. These we can discuss more in detail during this session and coming sessions. Finally, a ratio that we never want to use but we sometimes have to use is looking at liquidity ratios. So in the event that we had to liquidate the company, would the company be able to satisfy the short-term demands of customers or suppliers? This also can give us information about the tension that is going on in the cash management of the company. It's not only useful when the company has to liquidate, it's actually useful to understand what's happening and how it's, for example, financing growth. And that's especially relevant for this type of companies. Now it's moment to put some of those ideas in practice, select a company, apply the 14 ratios, analyze the results. You can stop the video here if you want. Once you have done this, it's the moment to upload those results and try to compare them with what other participants have found. Let's try to make sense how are there differences or not across the industries, and let's try to understand better what type of information do those ratios provide to you. Now it's the moment that we do this, but the inverse way. Now it's the moment that you select 5 ratios You set thresholds, upper limit, lower limit, and then you try to find companies that satisfy that. Share this with a colleague. Try to find whether you actually identified similar type of companies or actually there are very different companies in the two approaches that you have followed. Now you are ready to move into assignment 3.